The term hedge fund is one of those phrases we all sort of recognize, right? It brings up these images of, massive wealth, power, maybe even a bit of secrecy. But how much do we really get what they are deep down?
Yeah, and that's actually where the first big confusion comes in. The name itself, hedge fund. People hear hedge and think safety, like hedging your bets.
Right, like protection.
Exactly. But the hedge here isn't really about protecting you, the investor, from risk in the traditional sense. It's more about giving the manager freedom, strategic freedom.
Ah, okay, that's a key difference. So our mission today really is to peel back those layers. We want to figure out what a modern hedge fund actually is, how it works, and maybe why it's so different from, say, a mutual fund you might own. Think of this as your shortcut to genuinely understanding them.
Right. And historically, hedging was defensive, taking opposite positions to limit losses, like buying things that go up when other things go down, just to cushion the blow if the market tanks.
Okay, the traditional meaning.
But here's the paradox, the interesting bit. The name suggests safety, but modern hedge funds, they often use really aggressive, high-risk strategies. We're talking significant leverage sometimes to really amplify potential gains. So how does that square?
Yeah, how do you reconcile hedge with high risk?
It boils down to the manager's ability to go both long betting a price will rise and short betting a price will fall.
Oh, okay.
That freedom means they aren't just reliant on the market going up. That's the hedge in a modern sense. And this freedom lets them chase what we call absolute returns.
Absolute returns.
Yeah.
So not just trying to beat an index like the S&P 500.
Exactly. Not relative performance, but positive returns, period. Ideally, making money whether the market's up, down, or sideways. It's a totally different game, really driven by the manager's skill, or alpha.
Okay, that strategic freedom is key. But who gets to invest in these things? They seem pretty exclusive. How does that work?
It is exclusive, and it comes down to SEC exemptions. The idea is these investors are sophisticated. They're presumed to understand the risks, including potentially losing everything.
Sophisticated meaning wealthy, basically.
Pretty much. There are two main tiers. First, accredited investors. That's roughly earning $200,000 a year, maybe $300,000 jointly, or having a net worth over $1 million, not counting your house. Funds taking these investors are often limited, maybe 100 people.
Okay. And the next level?
Qualified purchasers. This is a higher bar. You need at least $5 million in investments. This lets a fund grow much larger, maybe up to 2,000 investors, before facing stricter SEC registration. And this exclusivity isn't just for show. It directly enables their freedom, because regulators figure these investors can handle the heat.
Right, they're playing with big chips, they know the risks. So with that freedom and capital, what are they actually doing inside the fund? What kind of strategies?
Oh, it's a huge range. Really sophisticated, flexible strategies. It's all about finding returns that aren't just tied to the market's overall direction. The classic one you probably hear about most is long-short equity.
Right, that sounds like the bread and butter.
It is. Basically, buying stocks they think are cheap or undervalued, while simultaneously shorting stocks they think are overpriced or flawed. It's playing both offense and defense in the stock market,
Makes sense. What else?
Well, there's event-driven strategies, like merger arbitrage.
Merger arbitrage. So betting on announced deals.
Exactly. If Company A is buying Company B for $100 a share, but B's stock is trading at, say, $98 just before the deal closes, the fund buys B's stock, aiming to capture that $2 difference when the deal finalizes. It's about exploiting small, predictable price gaps.
Interesting. And you mentioned global macro. That sounds big.
It is big. These managers make large, often leveraged bets on the direction of entire markets, currencies, commodities, interest rates, stock indices, based on their view of the big economic picture. And crucially, the amount of leverage, the borrowed money they use, is usually carefully tied to how risky they perceive that specific strategy to be.
Okay, lots of complex moving parts. Now let's talk cost. The famous 2 and 20. What does that actually mean?
It's the traditional fee model. Two parts. The 2 is a 2% management fee that's charged annually on the total assets in the fund, the AUM. It covers operational costs, salaries, research, and they get paid regardless of how the fund does.
2% just for showing up, basically. Does that dampen the incentive to really perform?
That's a common question. But the second part, the 20, is meant to align interest. That's the performance fee, typically 20% of the annual profits the fund generates.
Okay, so they get a slice of the winnings.
Right. But importantly, there's usually a high watermark.
A high watermark.
Yeah, it's a protection for investors. It means the manager only earns that 20% performance fee on new profits. If the fund loses money one year, they don't get a performance fee until they've not only recovered those losses, but also exceeded the fund's previous peak value.
Ah, okay, so they can't just get paid for digging themselves out of a hole they created.
Precisely. Though it's worth noting, while 2 and 20 is famous, the reality today is different. Fees have come down.
Oh, how so?
Yeah, significant fee compression,
Uh-huh.
driven mostly by big institutional investors pushing back. Averages now are closer to maybe 1.36% to 1.5% for the management fee, and maybe 16% to 19% for the performance fee. Still hefty, but lower.
Got it. So with all this complex strategy and money involved, how is it regulated, especially after, financial crises?
Regulation definitely ramped up after 2008. The Dodd-Frank Act in 2010 was a big one. It forced most hedge fund managers, those over a certain size, like $110 million in assets, to register with the SEC.
And what did that registration entail?
A key part was Form PF. It's a confidential filing. Funds have to report detailed info on what they own, how much leverage they're using, their exposures, their risks. The idea is to let regulators monitor for systemic risk, the kind that could take down the whole system. They even expanded it recently, 2024, to better cover things like crypto exposure.
So more transparency for regulators, but has it prevented blowups? Or is it more about watching things unfold? We've seen some big failures.
Right, and we learn a lot from those failures. Take long-term capital management back in '98. Brilliant minds, Nobel laureates.
Yeah, I remember that one. Huge bailout needed.
Exactly. Showed the danger of too much leverage and relying too heavily on mathematical models that couldn't predict real-world panic. Then there was Amaranth Advisors in 2006. A massive loss from betting heavily and wrongly on natural gas futures. A lesson in diversification, or lack thereof.
And didn't Tiger Management also run into trouble?
Tiger Management, Julian Robertson's fund, around 2000. That highlighted how, even if your fundamental analysis is right, the market can stay irrational longer than you can stay solvent. It really underscores that regulation tends to be reactive. A big collapse happens, then the rules get tightened.
So we've definitely covered a lot of ground here on these complex financial engines. It seems like they're defined by some real underlying tensions.
Absolutely, you see it constantly, that balance between risk and reward. The push and pull between secrecy, which they often want, and the growing demand for transparency. And even in the fees, that inherent dynamic between aligning interests and potential conflicts.
Looking ahead, what do you see? Continued fee pressure?
Definitely continued fee pressure. Probably a continued technological arms race using AI, big data for strategies, and for sure an ongoing watchful eye from regulators. But their core structure, that pursuit of absolute returns, means they'll likely remain a really important, if sometimes controversial, part of the financial landscape.
So here's something to think about as we wrap up. Even with more regulation, given how huge and interconnected these often quite secretive funds are, how might they still impact the wider financial system in ways we don't fully expect? It's definitely a question worth pondering as these powerful players keep evolving,